Hi. Thanks so much for inviting me to discuss this paper. I'm very sorry I can't be there in person. And let's jump right in. So, this is a super interesting paper. The background is that the banking industry has been moving from LIBOR to SOFR as its reference rate, meaning the rate you pay on floating rate loans plus a spread. So what's the difference? LIBOR is a risky rate, potentially reflecting bank funding costs, whereas SOFR is a secured rate. It's secured by treasuries. It's very close to risk-free and doesn't have this kind of time-varying risk component. So this paper is going to ask, how does this actually affect the market for credit lines and ultimately welfare? They're going to do this with a calibrated model of the credit line market, as well as some great supervisory data. And they show this leads to increased drawdowns, debt overhang, and bank losses in bad times. Understanding this, the banks are actually going to set higher spreads and smaller credit lines ex ante. And ultimately, this all leads to some welfare losses. It's not a really good thing. So, my evaluation, I think it's a great paper. I hadn't thought about this issue at all, but after it's kind of subtle, but after reading it, I completely buy the argument. And actually, in my discussion, the main thing that I'll try to convince you of is that some features that are not contained in the model, which is fine, all models kind of abstract from some things, but I think if you're going to think about them, they may actually imply the true costs are even higher than what the paper finds. So if anything, actually things may be even worse. So for background, let me just talk for a second about what I think of as the fragility of the credit line system. So the credit line system is actually huge, right? So banks, in my past work, and Stefan has found the same thing in his past work, we found that banks actually allow enormous amounts of undrawn credit line commitments. These are actually, for these banks that we're going to look at, about 40% larger than all credit lines, drawn credit lines and term loans combined. And these are actually offered at very reasonable spreads, even though they're often drawn in bad times when you think the banks really don't want them to be drawn. So why are the spreads not higher? So my conjecture, and now I learned that the fact that you get the LIBOR rate plays an important role, but it seems also important that they're also commonly drawn in normal times or with low risk. It's like kind of like an insurance market argument. If you don't have the healthy people, which are the firms who are drawing just when things are normal, just to cover some expenses, things would be a lot worse. But they kind of pool with the draws that happen during risky times, and that kind of keeps the spreads low. And this is what I'm worried about unraveling. So with the lower reference rate in bad times, when once you move to SOFR, everyone kind of will be aware of this, right? It's not like people don't understand this principle. So you might think, okay, well the banks can just still break even by raising the spreads, but this is kind of like raising the premium on an insurance contract. Because what it's going to do here is it's going to disincentivize using credit lines in normal times, right? Because even if everything's set up to break even, firms in normal times or when they're low risk will now look at their credit line with a higher spread. It will be less competitive compared to alternative sources of credit like bonds, commercial paper, even term loans, right? Um, and so as a result, I think you might see fewer use of the credit lines in normal times or low risk situations. But of course, just like with a health insurance market, if the firms are only using credit lines in bad times or when they're in distress, then the spread you just calculated is not going to work. You actually would need an even higher spread to break even because on average you're losing more when they draw. But the higher spreads puts us in a loop again where now this is going to disincentivize more using credit in normal times, et cetera, et cetera. And so just like a health insurance market, this can actually repeat in a feedback loop until you've kind of unraveled the market and this system where we have huge amounts of undrawn credit lines all the time might not be sustainable. So these forces are definitely present in the paper. I think they contribute to the welfare losses that the authors find. But actually, I was interested to see that quantitatively, they don't see tons of unraveling. The commitments are actually only about 3% lower under SOFR. So this is good news overall. I'm happy to see it. I hope it's true, but it ignores some potential risks and further costs that I think might make me a little bit more worried. So let's walk through them. I'll go through two main ones. So the first main one I'd like to talk about is deposits and how much they actually help. So the authors note correctly that a substantial share of deposits or drawdowns are actually redeposited at the same bank, particularly during the COVID crisis. So in the model, this is actually always a good thing for the banks because the firms never default, and the deposit rate is always below the rate that the firms get on the credit lines. So Basically, if the firms draw and redeposit, that's always a net win for the bank. And this actually helps offset costs of increased drawdowns in bad times, even under SOFR. So you're not getting as much as you would get under LIBOR, but actually because the firms draw more, you actually get more of these redeposits, and that actually helps you to some degree. But in reality, I'd like to make the case that even redeposited drawdowns are not a free lunch. They can have welfare costs. And so one big one is that actually there are some firms that are not even contained in the model, smaller firms that don't have credit lines. And in my work with John Craner and Pascal Paul, we find that these drawdowns actually crowd out a lot of term lending to these firms, which is a unmodeled welfare cost in this paper, even when they're fully offset by deposits. So let me quickly show you the main table of this paper. Basically, we're going to regress term lending to these firms on bank level drawdowns, as well as some Kwajamian style firm fixed effects. That's what's going to show up in the top row. And basically, all these negative numbers are evidence of crowding out. So what we find is basically for every dollar that's drawn down during the COVID episode, banks actually are contracting lending to these firms by between 10 and 30 cents. Now here's the really interesting one. We're also going to put in deposit flows at the bank, and we find it as a coefficient of 0. They don't really help that much. And overall, what this means basically is that if a bank has a large drawdown that's completely offset by deposits, every single drawer just redeposits the drawn amount at the same bank, you'd still on net get a very large negative effect on crowding out, basically. So why is this the case? Why don't the deposits work well? We believe it's due to capital requirements. So undrawn credit lines actually have a very low risk weight. Drawing a credit line increases this risk weight by doubling it, or at least it could actually potentially be more. And when your risk weight increases, if you're kind of concerned about your capital requirements, you can't offset that with deposits. You need to raise equity, which banks don't want to do for all kinds of reasons. But basically, the short story is deposits won't help you there. And so this crowding out should happen even if they're redeposited. Now, that's kind of a spillover to these other firms. But Acharya, Engel, and Stefan come and say, actually, this is even bad for the banks. And they find that drawdowns actually also depress bank equity values, even when they're offset by deposits. So the same exact thing holds. Drawdowns lower the bank equity returns, and deposits do not offset this effect. And this is kind of the same argument again. These drawdowns tighten the bank capital requirements, and that actually, we were thinking in our research about how this hurts other firms, potentially actually deepening the recession, causing all kinds of other problems. But this Acharya et al. Paper makes the great point. This also hurts the banks because it actually prevents them from doing profitable lending at times when there may be very good opportunities. So actually, even if you look at this paper, which is very focused on what happens to the banks themselves, bank profits, stuff like this, I think it could also have very negative effects. So two other simpler ones. First, the paper ignores default risk by borrowers. In reality, default risk is often above average when credit lines are drawn, either because the macro state is bad or firms are in distress. This is going to make the cost to banks of additional drawdowns in bad times even worse than modeled. So that effect will be stronger. And it also makes the adverse selection problem worse. So if you think about the health insurance market, in this model, no one's ever just unhealthy in normal times. It's just that you get into kind of bad times and don't want to lend to them. But in reality, you have unhealthy people all the time, and that is going to potentially lead to more unraveling. The second thing, which the authors clearly are aware of, is that firms can sometimes have a run-like drawdown behavior. The logic, if banks are unhealthy. So the logic is if you think a bank is unhealthy, you may as well draw your credit line now while the bank can still honor it. And that actually can, of course, have a self-fulfilling prophecy, just like all runs, and it's very, Anyway, people understand this. The author's clearly aware of this. They model it as an extension, but this is not part of the main results. So I think if you included that, it would make the main results even worse. In this run system, the firms are very unlikely to deposit funds at the same bank. And also, to the extent that falling bank net worth can trigger runs and cause costly bank failures, etc., this could increase welfare costs further. Now, I'm going to close with a very interesting thought that this paper stimulated for me. So the question you might be wondering is, if moving to SOFR is so bad and it particularly harms the banks, why are they doing it? So if you go on Capital One's website, they basically say, well, we don't want to, we have to. So over time, the market that determines LIBOR just stopped having significant transaction volume, whereas the repo market that determines SOFR has a large transaction volume, basically. And one thing that's always come up in whenever I work on projects about banks and firms and things is that financial contracts, there's often the question of like, why aren't they more state contingent? And basically, my explanation is financial contracts seem to have a very strong preference for simplicity, and they really seem to only benchmark to the prices of widely traded assets. And an important thing this paper points out I hadn't thought about is that as a result, the set of the priced and widely traded assets available can really shape the contracts you can write. And in this case, losing volume in this one market and not having a good substitute that varies in the right way with bank funding costs actually is leading to some pretty serious welfare consequences. And so my closing thought is, since the existence of these assets can expand the contract space, like if opening kind of a LIBOR market again that had a huge volume, or something similar that reflects bank funding costs would help, these assets are kind of in some sense a public good, or at least having high volume in them. And if and how central banks or governments should try to shape or support these markets in order to expand the contract space is kind of an interesting question for future research. So let me wrap up here. This paper has a model of credit line provision with some great supervisory data to look at the consequences of moving from LIBOR to SOFR. It worsens debt overhang, shrinks the credit line market, and reduces welfare. But I think that even though they find it's costly, the true cost could be even higher due to these drawdowns crowding out term lending to small firms and hurting the banks further because of tighter capital requirements, as well as the simpler ones I mentioned with the firm defaults and drawdown runs. And overall, I had this final thought that spillovers from trading volume to asset contract terms may actually deserve some policy consideration. Thanks very much.